Welcome to the weekly wrap-up where we take a look at what economic events were moving and shaking the markets this week. Today I'm joined on the line by Merina Willemse, economist at Efficient Group. Hello Merina. Which events this week do you think had the most impact on markets?
Well, I would say that the Federal Reserve Bank of the US FOMC minutes really shocked the market when it indicated that there was a split view among the constituents surrounding the continuation of the current level of the monetary stimulus that they're providing at the moment to that economy. I think most market movements and most asset market gains that we've seen lately has been on the back of a perception that this stimulus will continue indefinitely until the American economy reach the acceptable level of unemployment. And that has not really happened yet. So when they start talking about removing that stimulus, markets really fell back across the board. And even in South Africa, we also saw the pullback on the back of that news.
Applications for unemployment benefits in the US rose for the first time in 3 weeks, returning to levels seen prior to the holiday period and indicating little change in the pace of firings. And jobless claims increased by 20,000 to 362,000 in the week ending February 16th. What are your thoughts on this?
Well, even though there is an increase in this level, I do think it was expected. The jobless claims at the moment are tracing along the lines of their long-term average of about 695,000. It's an average of 363,000 between 1967 and 2013. So it's very much in line with its long-term average. And it's not yet at that extreme point of 695,000 in October 1982. So we're not really seeing that number at extremely elevated levels, but also not reaching its bottom-up level during that time, which was about 162,000. I think on average this is not something to worry about yet. There's several other things going on in the American economy that we can keep track of. But I don't also, in the same sense, I don't expect this number to improve significantly throughout 2013.
UK unemployment rose to 7.8% in January and initial jobless claims rose to minus 12.5k. Also concerned about economic growth remain, with the Bank of England's Monetary Policy Committee more divided than expected over whether to provide more stimulus, according to minutes of its latest meeting. What are your thoughts on this UK data?
Well, I think that if you look at the labour situation in the UK, there's been incredible pay cuts. And that has supported employment in the last few months. But we, as you said, we're not really seeing the numbers of unemployment coming down significantly. Latest economic growth stats out of the UK also showed signs of the economy slowing slightly. And we know that there's going to be continued pressure on budget cuts in the UK, which is probably going to have an impact on growth again. At the moment, the market's really concerned about a triple dip within the UK economy, and that's going to impact on confidence within that economy and globally. And if we see further weaker data coming from the UK economy, I don't doubt that there will be further stimulus action from the central bank.
US Consumer Price Index for January remained at 1.6%. Is this a good sign for the US economy?
I think that the fact that it's stable was again relatively expected. It was because food prices were relatively flat, gasoline prices dropped. But there's other things that are very concerning in the UK and the US economy that still affect today. New jobless claims that we spoke of are up. Factory activity slowed in February. The unemployment rate has weakened, not improved. So this economy is not out of the woods yet. We know that they're going to keep interest rates low until that unemployment reaches that 6.5% that the Fed has mentioned. But if they start talking about changing the actual stimulus that they're providing at the moment, the monetary stimulus, I don't think it's because they think that the economic factors are improving. It's just because they're starting to get very worried about the cost of doing this unconventional method of monetary policy. And I don't actually see that the economic situation in America will improve that much this year for them to remove or to lower the stimulus that they're currently providing that economy.
And what do you make of the German GDP figures released today, which remain unchanged year on year and quarter on quarter?
Well, I think that it was expected. I think the biggest surprise perhaps from this number was that the foreign trade component contributed the most negatively to economic growth. And what we can make from that is just that Germany is suffering the consequences of a very weak Europe at the moment. There's not clear demand coming from Europe, therefore Germany's exports to the rest of Europe is very weak, and this is really contributing to weak economic growth in Germany. As a whole, I think that even though Germany is the strongest economy in Europe, it will be dragged down by very weak economic situations within the rest of Europe, and that's a very unfortunate situation for Germany for sure. But I think these economies are going to need a few years to improve from the current situation.
Thanks for joining me, Merina. That's all for now, but join us on Monday for the week ahead to see what events could move the markets next week. Have a great weekend and goodbye for now.